Do I look like a finance bro or like a tech bro? I just did an audition for a project where I'm supposed to look like a finance or tech bro. And this is the outfit I chose. And frankly, I get it. I get why finance bros wear this in Midtown Manhattan, going down to Sweet Green or Cava to get their salad. It's a really practical outfit. This vest keeps me warm, but not too warm because my arms are exposed. And I could just easily take this off if I'm too hot. I'm a big fan. Let me know in the comments. Did I pull it off? Do I look like I'm a finance bro? I mean, I kind of am a finance bro, so. Okay, let's get started. In this video, I'm going to provide an update on my top 10 holdings. I'm going to highlight a few of the companies in the portfolio and break down all the stocks I've purchased in the last week or two. I'll also be sharing a few stocks I don't own yet, but I'm watching closely for an entry point. And finally, I'll be sharing one stock you couldn't pay me to own. For reference, I have a video on my channel detailing my top 10 holdings, how long I've held each stock, and why each of these companies deserve a spot in my top 10. Feel free to check that video out after this one. Quick disclaimer, I'm not a financial advisor. This is just an analysis of stocks I own. Always do your own research before investing. All right, let's do this. All right, let's take a look at the current top 10. A few items to note here. All the companies highlighted in purple pay quarterly or annual dividends to shareholders, and the green companies are all founder-led. Now, at first, I ruled out Netflix, Amazon, and Google as founder-led companies because their founders are no longer serving as CEO. But after digging a bit deeper, Reed Hastings and Jeff Bezos remain deeply involved as executive chairman, and in Sergey Brin's case at Google, his control through share structure still gives him significant influence. That degree of influence and decision-making power, even without holding the CEO role, still defines these businesses as founder-led. Notice there are only 4 companies of the 10 that are both founder-led and pay dividends: Google, Nvidia, Meta, and Prologis. These 4 stocks are the crown jewels. Founder-led companies tend to outperform over the long run, and collecting a quarterly dividend simply for holding the stock is an added bonus, especially when those payouts are reinvested to compound your ownership over time. These top 10 holdings account for 85% of my entire portfolio. My top 5 holdings, Tesla, Google, Nvidia, Apple, and Meta, occupy 67%, and positions 6 through 10 occupy 18%. So my top 5 holdings alone account for well over half of my entire portfolio. I have very heavy conviction in these 5 companies for the long term. For reference, my entire portfolio consists of 25 to 30 stocks, and I'm actively trying to shave that down to 15 positions max. 6 months ago, I had closer to 40 stocks. That's just too much in my opinion. Keep in mind, each of these companies have earned their position in the top 10 after years and years of mistakes, lessons learned, and money lost. I've been investing for about 20 years through the great financial crisis, COVID, the 20% market correction in 2022, and more. I've learned a lot through the years, and it's taken 2 decades to arrive at these top 10. And the journey is never over. These companies are not permanently calcified in my portfolio. They're subject to change depending on a number of factors, including management, execution, and huge shifts in the global economic landscape. It's rare, but when it makes absolute sense, I will sell a company I've owned for many years if the narrative has changed or management has consistently executed poorly. Now, you'll notice there are a few Magnificent 7 names in my top 10, and you might be thinking, oh, how original. He just owns Mag 7 companies. He doesn't even share any secret stock tips that'll go to the moon. Yeah, you're damn right. I'm not in the business of trading speculative stocks, hoping to make a quick buck. Believe me, I've done that before. And the ROI on the amount of time and stress you spend trading is just not worth the return. And B, the return is usually pretty terrible. You might get lucky and make a quick buck, but in the long run, based on my experience, and believe me, I've tried, it's just not worth it. Average returns over an above average amount of time, 5 to 10 years or more, is my preferred strategy. Credit to Morgan Housel for those words of wisdom. And my cost basis for several of the Mag 7 companies in my portfolio is significantly lower than their current stock price, as I purchased them many years ago. For example, I've owned Apple for 13 years and Netflix for over 7 years. Nvidia, Google, and Tesla, each for close to 5 years. They've earned their position in my top 10 by growing significantly through the years. This is an important distinction. Today, I want to focus on 3 of the companies in my top 10. Prologis is the world's largest owner, manager, and developer of warehouses and distribution centers. They provide a whopping 1.3 billion square feet of space for customers like Amazon, FedEx, and Home Depot. The stock is up 60% since the tariff sell-off in April of last year, but if you zoom out, it's traded pretty much sideways over the past 4 to 5 years, and it's actually only up about 67% in the time I've owned it, which is over 6 years. Not a great return for that amount of time, but the dividend payout is quite healthy for shareholders. They've increased their dividend for 13 consecutive years, with a 5.9% increase announced last month. I've set up automatic reinvestment of all dividends, so my share count just keeps increasing every quarter, which has compounded very nicely over the past 6 years of ownership. I did, however, sell 4.8% of my Prologis position 2 weeks ago to reallocate to a rare opportunity, which I'll reveal later in this video. Prologis is like the refrigerator in your kitchen. Everyone has one. You definitely need to store your perishable food, and life would be significantly worse without it. But you don't really think about it from day to day. It's just there, doing its job. That's Prologis. Without their warehouses and logistics infrastructure, your 2-day Amazon delivery would likely turn into a 5 to 7 day wait. Not the end of the world, but an inferior experience for sure. It's one of those companies that I don't mind owning until I'm like 70 years old. It's also fairly AI resistant, given it handles physical, real world inventory, and it services some of the largest companies in the world like Amazon and FedEx. It's one of those boring, unsexy companies that's core to the infrastructure of society and will just keep chugging along month after month, year after year. Netflix has been an interesting one as well. As you all may know, less than a week ago, Paramount raised their bid for Warner Brothers, and Netflix decided to walk away from the acquisition, which means Paramount will ostensibly own Warner Brothers. Netflix will be paid a $2.8 billion breakup fee from Paramount, not Warner Brothers, and Netflix will not be shouldering $70 to $80 billion of debt for the buyout. I was initially shocked and a bit disappointed by the news, but after a good night's rest, I'm very happy with the decision not to overpay for Warner Brothers. Netflix will be perfectly fine without them. Squid Game, Bridgerton, Stranger Things, K-pop Demon Hunters, all huge global hits without Warner Brothers. I commend Netflix management for choosing financial discipline and not overpaying over ego. A nice little bonus, the stock shot up 14% the day after they announced they'll be passing on Warner Brothers. Nvidia reported earnings last week and knocked it out of the park. Objectively excellent numbers, and the stock sold off by 10% in the 2 days following the report. Now, to be fair, Nvidia stock is up 94% in the past 10 months alone, and zooming out, up 175% in the past 24 months. So I think the stellar earnings, despite beating almost all Wall Street estimates in both earnings and guidance, were already baked into the share price pre-earnings. Now, because the price of 3 of these companies in my top 10 holdings dropped quite a bit in the past few weeks, I took advantage of the dip and purchased more shares. Want to take a guess which companies those are? Make a mental note or write it down, because I'm about to reveal them. In the past few weeks, I've purchased more shares in 3 companies. The first is Nvidia. As I mentioned earlier in the video, the stock dropped 10% after stellar blowout earnings. I believe Jensen Huang is a generational leader, one of the best to ever do it, and right up there in the top 5, possibly top 3 tech CEOs ever. Now, if you're watching this video, you and I live in a bubble. I know, it's hard to believe and you may not realize it. I know several people who haven't even typed ChatGPT into their web browser before, and plenty of people who are against using AI and have no idea what Anthropic is. We're still very early, and I think Nvidia is core to the mass deployment of AI to every industry you can think of. So I picked up some more shares in the $175 to $189 range because the stock dropping 10% after generating $68 billion in revenue last quarter and guiding for $78 billion next quarter, both exceeding Wall Street's estimates after 13 consecutive quarters of beating Wall Street estimates is bonkers to me. Second is Netflix. As I mentioned in a video I posted earlier, based on the terms of the Warner Brothers deal, Netflix wins regardless of the outcome. If the deal had worked out, they would own arguably the most iconic library of TV and film assets in the world. If the deal didn't happen, they get paid a $2.8 billion breakup fee by Warner Brothers. Well, the deal didn't happen, and not only did they already get paid the $2.8 billion breakup fee, but even better, Paramount said, no. Warner Brothers, we got you. We'll pay Netflix the fee. Absolute music to my ears. Because I knew Netflix wins no matter what the outcome, I took advantage of the 40% drop in stock price and purchased a ton of shares in the $75 to $90 range. Third is Meta. They reported stellar earnings at the end of January. The stock shot up 10% the next day to $738 and then dropped 14% to as low as $638 again in the following weeks, ostensibly due to a combination of A, extreme negative sentiment surrounding software companies getting disrupted by AI, and then B, their exorbitant capex for data center buildout. Basically, PTSD from their extreme metaverse pivot a few years ago that led to a $750 billion wipeout in their stock price. Now, I've talked about Meta quite a bit on my channel and their ability to overcome everything from the Cambridge Analytica scandal to TikTok to the metaverse correction. Meta is like a queen bee cockroach, literally unkillable. You could throw everything you want at the company. They'll still come out stronger on the other side. So I purchased more shares in the $630 to $645 range in the past few weeks. And per my comment earlier, I sold 4.8% of my Prologis shares to reallocate into Meta. It's a great opportunity trading at a solid discount, and I want to take full advantage while I have the chance. In terms of stocks I'm watching, first is Amazon. I already own a ton of Amazon. It's my 10th largest holding, but the price is looking pretty attractive. The stock has dropped quite a bit after earnings due to their guidance of $200 billion to be spent on AI data center buildout. Reinvestment in the company has been core to Amazon's ethos since day one. They don't pay any dividends. They'd rather deploy their profit back into the company to build out the distribution warehouses, the trucks, the planes, AWS, etc. Because of this mentality, you often see huge dips in the stock price because short-term investors don't see a big payout in the next quarter or two. But if you're a long-term investor, then you're looking at a 730% rise in stock price over a 10-year period from 2016 to today. Come 2030, my guess is Amazon stock price will be significantly higher than it is today. I'm considering acquiring more shares if it drops into the $180 to $190 range. I'm also looking at Chipotle and TJX, owner of brands like TJ Maxx, Marshalls, and Home Goods. But to be honest, I think there's a low chance I'll invest in either. TJX, I desperately want to own, but I can't get myself to purchase at a 52-week high and all-time high. If there's a huge drop due to the Iran war escalating or some other global crisis, I will gladly initiate a position in the low 100s, maybe 100 to 110, ideally under $100 if possible. And Chipotle? Well, I've been frequently Chipotle in the past few weeks. $12 for a solid bowl of greens, rice, carnitas, corn, and peppers is honestly such a great deal for a relatively healthy meal and pretty recession-proof at that price point. The stock has dropped 53% in the past year or so and is back up a tad since the bottom. And the last time the stock hit this low was 3 years ago. I'm probably going to sit this one out, as restaurant and dining stocks have never done well for me. I own Sweetgreen and Kava, and neither worked out in my favor. But more importantly, I don't have the conviction to hold restaurant stocks through significant drawdowns like I do Nvidia or Google. And finally, a stock I have zero interest in buying, Duolingo. Now, this is a controversial one because some are hugely bullish and others are like, no thank you. I think it's only a matter of time before Anthropic or OpenAI releases software that's able to not only replace Duolingo's learning capabilities, but offer superior services. As sad as it sounds, in the long run, I really don't think learning languages will be a huge priority. In fact, I'm pretty surprised we don't already have a device that can just translate in real time between people. Just like the programming language has evolved from C++, Java, or HTML to English, meaning you can just tell Claude Code, make me an iPhone app that tracks my daily protein intake, and it'll code it up in 30 seconds. I believe human languages will eventually be solved by AI. No need to learn new languages, which is a bit sad because so much of cultural nuances, cuisine, and traditions are learned by way of language. But being able to communicate with literally anyone in the world without the barrier of being lost in translation might unlock more upside for humanity than years and years of learning a language to perfection. So there you have it. That's an update on my top 10 holdings, what I've recently purchased, what I'm eyeing, and what I definitely will not buy. What are your thoughts? You think those are good purchases? Have you been buying Nvidia or Meta stock? Let me know in the comments below. Thanks for watching, and I'll see you in the next one.